Welcome to The Explainer. Today, we're kicking down the doors of Wall Street to totally demystify elite hedge funds. We're going to look really closely at exactly how these financial giants manage literally trillions in assets. And how do they generate billions of dollars in returns? Well, it's this incredibly fascinating mix of deep math, human psychology, complex algorithms, and just sheer information. By the end of this explainer, I promise you, the so-called black box of high finance isn't going to seem so mysterious anymore.
Okay, let's dive into this. What if the world's top hedge funds actually knew something that ordinary investors don't? Well, spoiler alert, they do. But, it's not magic. Some of these elite funds have built massive, mind-boggling fortunes using strategies that are pretty much completely hidden from the public eye. So today we're going to uncover exactly how these hedge funds actually make their money and what hidden strategies they're using behind closed doors to build that staggering wealth. So here's our quick roadmap for today. First, we'll tackle the hedge fund mystique. Then we'll look at the information advantage, crack open the strategy playbook, give ourselves a quick reality check, and finally wrap up with everyday lessons. Let's get right to it.
Part 1. The hedge fund mystique, defining the black box.
And this brilliantly illustrates the big difference here. See, normal mutual funds, they usually just focus on standard growth, tracking right alongside the broader economy. But hedge funds, they play by a completely different rulebook. A hedge fund is essentially a private investment partnership, and it's designed specifically for wealthy investors and huge institutions. Because they operate differently, they can use super aggressive tactics. We're talking leverage, short selling, and crazy complex derivatives. Their goal isn't just steady standard growth. No way. Their absolute goal is outperforming the market entirely. Period.
Moving on to part 2. The information advantage, speed, and tech.
Now, what's really interesting about this is the sheer length top firms go to for an overwhelming edge. They spend billions. They're deploying wildly advanced AI systems and literally using satellite tracking to watch global shipping movements from space. They aggregate credit card spending data, analyze real-time internet trends. It's wild. They're processing these massive data sets way before the public even senses a shift in the wind. Get this, some firms have actually spent millions drilling straight through mountains just to lay straighter fiber optic cables. Why? All to shave mere microseconds off their trading times. Microseconds. Like the saying goes, in finance, information arriving seconds earlier can mean millions of dollars. Time and speed are absolutely everything here. It's not about luck, it's about getting the data first. They employ elite analysts and top-tier mathematicians strictly for this purpose. Because think about it, if they can process a satellite image or a shipping log just milliseconds before the rest of the market, they can position their immense capital to capture absolutely massive profits.
Okay, part 3, the strategy playbook, inside the systems.
So inside these firms, elite funds deploy vastly different systems. Take quant funds, for example. They rely strictly on algorithms and intensely complex mathematical models to place their bets. Then you have global macro funds. They take a massive top-down view, literally betting on whole economies, currency shifts, and global interest rates. And then meanwhile, activist funds are super hands-on. They'll buy huge stakes in companies and aggressively push for changes in management or operations just to drive the stock price up. They're all targeting completely different arenas of the global market.
Then there's arbitrage. This is a very specific, razor-sharp tool that a lot of funds focus heavily on. Basically, it's the practice of exploiting tiny, almost invisible price differences for the exact same asset across different markets. Think of it kind of like buying a stock in London and selling it in New York a fraction of a second later. It's all about finding minor market inefficiencies and striking instantly. And sure, while the price difference might be literally fractions of a penny, when you're moving billions of dollars, well, those fractions turn into massive profits.
So the crucial point is that the real secret to the architecture of elite hedge funds is that most of them do not rely on just one single strategy. They're combining dozens of these systems together. By weaving quantitative models, macro bets, and arbitrage all together, they build this highly powerful, robust safety net. This multifaceted approach is essentially designed to simultaneously reduce their overall risk while maximizing every possible opportunity that pops up in the market.
Which brings us to part 4, the reality check. Do hedge funds always win?
Now, let's get real for a second. Despite their almost untouchable reputation, hedge funds do not always succeed. Actually, some collapse pretty dramatically. Those highly leveraged bets we talked about earlier, they can destroy billions of dollars literally overnight because they borrow so much money to multiply their gains. If a trade goes the wrong way, well, their losses are heavily multiplied too. Even legendary, world-renowned investors experience dramatic, incredibly painful losses. They definitely aren't immune to the market's gravity.
It all comes down to this idea: in investing, surviving bad markets is just as important as winning good ones. And honestly, this is what truly separates the elite survivors from the spectacular failures. I mean, anyone can make money when the market is booming, right? But protecting your capital when everything turns red, that is the true hallmark of an elite system. The absolute best funds in the world obsess incredibly heavily over risk management.
Let's move on and see how this builds into part 5, everyday lessons, what normal investors can use.
Okay, so we probably don't have billion-dollar AI systems or our own private satellites, but we can absolutely use universal principles straight from the hedge fund playbook. Number 1, diversification. Don't risk it all on one bet, just like funds combine dozens of strategies. 2, risk management. Always know your downside and fiercely protect your capital. 3, patience. Even supercomputers wait for the exact right moment to strike. 4, data-driven decisions. You gotta ignore the noise and look at the actual facts. And 5, emotional discipline. The biggest lesson from top investors isn't about wild gambling. It's about consistency. It's about stripping the emotion out of the process, relying on solid research, and just protecting what you have.
The financial world ultimately rewards those who understand systems better than anyone else. In modern markets, knowledge itself has become the most valuable asset. It's not magic, guys. It's just information, strategy, and discipline. I really want you to think about that the next time you look at your own portfolio. Are you operating on emotion, or are you operating on knowledge? Thank you so much for joining me for this explainer, and keep learning.